Okay, welcome to today's presentation. The topic is financial planning considerations for mixed nationality couples, obviously with a very distinct focus on Americans and Australians, either Americans in Australia or Australians in America. Some important things to note here: this does not constitute personal financial tax or investment advice. You would be crazy to make what could be permanent and irrevocable decisions based upon general educational information such as this. I only provide personal information to clients. All the information sourced here has been sourced from sources we believe to be reliable and accurate. And the other thing worth mentioning is we do recognize non-heterosexual couples. However, in this presentation, to keep things on the straight and narrow, we are using traditional gender pronouns here. Do note our YouTube channel, so our presentations are all recorded. Invariably, I'll get an email. Someone always asks, is this going to be recorded? And it always is. So you're welcome to go to our channel, subscribe, and you will be able to see this video. And please let anyone else know about this resource that is available. A little bit about me. So I'm a tri-citizen, born in the UK, raised in Australia, spent 16 years in the US, and technically the US is still my domicile, but I'm here in Brisbane, Australia for the next 14 months. We recorded a series about what it took to move a family in the middle of the pandemic and all the logistics and financial planning and tax planning that was involved with that. Let me see. I became an advisor in 2010 and was really struck by the lack of resources available for financial planners wanting to deal with clients whose lives cross borders. And it was for that reason I founded the GFP Institute in 2020. We have a masterclass. I train other financial planners in how to approach cross-border planning. And I've been featured extensively. In fact, just yesterday in Advisor Perspectives, really something focused, a periodical for financial advisors, but nevertheless talking about the need for this specific education. And that's what I'm hoping to give you here today is more information on planning for cross-border issues. I'm sorry, I'm just laughing because I realized, I'm sorry, I forgot to change my background. I see I've got my GFP background there. So let's change that back to Arete. So some examples of the kinds of issues we assist clients with. Broadly, three different categories here. You see the Aussie business owner in the US, the high net worth Aussie family living in the US, and the Aussie executive family that has permanently relocated to the US. There's also a whole slew of investment matters that I assist with Americans in Australia. But it's important to note, I'm not licensed in Australia. I do not have an Australian financial services license, but I do work very closely with a number of firms to be able to provide that book-ended kind of advice many clients are seeking. So today's presentation, what shall we be talking about? We'll be going through and looking at one's current living situation versus where you plan to retire and how that brings up issues related to having a spouse of a different nationality. Couple specific attitudes towards the pooling of wealth, given the significant implications of asset ownership and tax implications of income and attribution as who recognizes the income. We have to go through the legal residence versus the tax residence to be clear on our terms. That's something that frequent attendees of these webinars will have seen me talk about before. We'll talk about the US taxation for the non-US spouse and what different tax filing statuses look like and their pros and cons. The relative incomes of the couples and how that factors into that decision as to the filing status, and what the account ownership options are and the pros and cons of those different ownership options. All right, let's get into it. So residency versus domicile. We've got to be really clear on our definitions here. So in the US, the immigration laws have distinct definitions of residency when compared to the tax laws. So we have legal residency or immigration status is another phrase folks may hear when talking about one's legal status in the US. So you're either one of four. This covers 100% of individuals out there. You're either a US citizen, a permanent or conditional resident. Conditional resident is someone who's on that pathway to becoming a permanent resident. A non-immigrant, that's someone, you may be in the US, you may be there as a visa holder, or if you're in the US and you don't have any of the three above, then you would be called undocumented. So those are the legal residency statuses. And how do they differ from the tax residency statuses? Let's have a look. You're either one of a couple of different tax residencies. Your citizens and permanent residents are all, this is a critical distinction for understanding US taxes. And that is, if you are a citizen or green card holder or current green card holder, you are always a US tax resident regardless of where you are. So that differs importantly from Australia, where if you are in Australia, Australia will tax you on your worldwide income. But if you are not in Australia, if you're overseas, the ATO will only want to tax you on what is deemed to be Australian sourced income. Australia says, well, you're not here. It's not really fair to tax you on your income that you're earning overseas. We're only going to tax you on the income that you are earning here. So what are some examples of Australian sourced income? They would include things such as real estate. Many prospective clients and existing clients have investment real estate in Australia. So it doesn't matter where you are, Australia is going to tax that because obviously it's physically present here in Australia. Australian businesses, they are effectively connected to Australia, therefore they're Australian sourced, and Australian trusts, although trusts can be quite troublesome from a US perspective as well. So non-citizens are one of two things. They're either resident aliens, that's the very flattering term the US uses. Even more flattering is non-resident aliens. So a resident alien would be someone, just to use my cursor here, that would be your folks here. The resident aliens would be your permanent residents or your non-immigrants that are in the US, say on an E3, L1, O1, H1B type visa. So they would be called a resident alien for tax purposes. And that's an interesting one because yet again, you're taxed on your worldwide income. But when you leave the US, if you no longer have that visa or surrender your green card effectively by filing Form I-407, then you're no longer a US tax resident. But we go down a slippery slope. This slide is like a black hole that we can disappear down because then it brings up the problems that exist for long-term US residents under the HEART Act, the Heroes Earnings and Repatriation Tax Act of 2008, where long-term residents, those folks that have spent more than eight of the past 15 years in the United States, will now and forevermore be deemed, they will be assessed whether they are a covered expatriate. And the bar for passing that for many prospective clients I speak with is pretty low. There's three tests. There's are you current in the past 5 years, are you current with all your state and federal tax filings? Did you have an average federal tax bill of, I believe it's about it's in the 160, 170, that bracket, 160, $170,000 a year over the past 5 years. You got to be making real money to have an average federal tax bracket that high. Or the low branch that hits most people walking out the door is, do you have a global net worth of more than $2 million? So that's going to catch a lot of people. So we've got to be careful of immigration planning and how that factors into financial planning. Okay, current living situation versus where you plan to retire. I happen to believe that it makes the most sense for Australians and Americans. It doesn't apply necessarily for other countries because of specific attributes to the investment environments of Australia and the US. And they're both pretty good. The US is definitely number one, much lower cost. There's no platform fees, there's rarely trading fees. and the availability of product is much broader. And that's been shown by Morningstar in study after study. They have a biennial global investor experience study, and that's what they've shown. But be that as it may, it's still advisable to locate the majority of your assets in your country of domicile. So domicile being, where do you see yourself long term? And I think this comes up most frequently with retirement, or someone who may be in one of those two countries we're dealing with here for a shorter period of time. If you're going to be in the US or be in Australia for only a couple of years, then you really wouldn't be well advised to keep the majority or transfer the majority of your money to a country you're only going to be in for a short period of time. I would put it to you primarily because of foreign exchange risks. However, in this topic that we're talking about, there are so many caveats, so many ifs, so many asterisks over any statement that we need to be careful. And the main one that jumps out to me is when you have a mixed nationality couple and one of those spouses is an American, then the US, there's all sorts of tax complications that come with being an American, and often the simplest way to resolve those will be to maintain most, if not all, investments in the US, but lots and lots of particulars there. So as you heard me say, your foreign exchange is a big factor that comes up. The thing with foreign exchange, I'll just briefly go and talk about that for a moment, is unlike investments where financial advisors, including myself, would suggest to you that it's a wise idea to essentially not try and time the market and get into the market and dollar cost average your way in. Don't keep your money in cash hoping for that right occasion when you're going to find a dip. And we've seen that especially in the last dozen years, since March 9th of 2009, when we hit the bottom of the global financial crisis, and we've seen one of the most spectacular bull runs in all of history. And had you stood on the sidelines saying, "Oh, no, it's going to correct," the GFC was just a tremor of something bigger to come, you would have experienced, not experienced a loss, you would have missed out on tremendous gains in that time. Foreign exchange, on the other hand, doesn't work in the same way. With markets, we see over time, they gradually increase. As economies develop, as the world grows and does more trade, we see the value of companies increase over time. Not so, we don't see this inevitable, inexorable rise with foreign exchange. Instead, we see it fluctuate all over the place, and it's driven by a whole range of factors, and I've got a separate webinar talking about foreign exchange factors. But that's why I come back to foreign exchange as being such an important factor here in thinking about where to hold your assets in the first place. And then you can see down the bottom there that my point about shorter term stays, and indeed in my own situation here, my family's moved back to Australia for about 18 months. I'm essentially not moving anything as far as my financial life is concerned. Obviously, month-to-month spendings, emergency funds in Australia, but all other investments, retirement accounts, everything, just keeping that back in the US for simplicity's sake and to avoid foreign exchange losses that may or may not occur in this time. So going to take a slightly different angle here and bring up the topic of attitudes towards pooling of wealth. Now, why is this relevant to today's conversation? And that's going to be apparent in a moment when we talk about tax filing statuses and the liability that, well, the headaches, the reporting headaches that the non-American spouse may have to open themselves up to, and the liability that they may open themselves up to with their spouse's U.S. tax filings. As we'll talk about, the married filing joint means that you are on the hook, you are obligated, you are liable for the tax reporting of your spouse. So attitudes towards money, we've seen each individual, obviously people have their own familial attitudes towards money and what they believe is they're comfortable with. we may see clients with children from past or present relationships. Each individual's consumption habits could be wildly different. Could have health situations that are different, special needs situations. There could be a big age difference. One spouse is retired or not, employment status, length of, all these different things are going to have an impact on one's attitude towards the pooling of wealth. And indeed, not just the attitude, but necessarily the desirable split to produce better financial outcomes. So tax treatment of non-US persons. So as we have already been over on the first slide after the outline here, you're either a non-resident alien or a resident alien. And a non-resident alien, they're automatically considered non-resident aliens by virtue of not being in the US. You cannot be in the US and be a non-resident alien for tax purposes unless you have been there for less than 183 days, or I believe it's 122 days over a 3-year period. So that's what the SPT, substantial presence test. That's what I was just referring to a moment ago. Oh, excuse me. I'm sorry. Let me get that back. Sorry. Just getting there. So the non-resident alien, they're taxed only on their effectively connected income that is sourced to the US. So not unlike what I mentioned earlier to do with Australia and having a business or real estate or a trust. It's a similar situation. The exact things that are sourced to the US are going to be a bit different. So it does depend. But as a non-resident alien, you're going to be taxed on your US sourced assets. And of course, there's so much complexity that comes up here with all of the possible permutations that we see. So we may have a couple that move to Australia and no longer one of the spouses who has become a non-resident alien, as they may have been in the US as a resident alien while they were here on a visa of some sort, moved to Australia, but yet own a business back in the US. That's going to be interesting because that's going to be considered US source income. And then importantly, we're not going into it today, but importantly, there's a massive estate planning complications that exist there. And that is where a US spouse or a US citizen couple would have an unlimited marriage transfer gifting situation between the two of them. They could gift an unlimited amount and then have up to $11.2 million estate tax exemption. Nothing of the sort for the non-resident alien. There's a $60,000 exemption. So if in that hypothetical scenario I just reviewed, where you've got the non-resident alien owns a business or owns real estate or some other asset in the United States, and they pass away, then that spouse, unless estate planning has been done, and there is some that can be done actually after the fact, unless some estate planning is done, they're up for a 40% tax on the value of that business above $60,000. So massive implications for estate planning right there. Taxation of resident aliens is essentially the same as it is for US citizens. It's when you're in the US, it's very little difference. It boils down to gift and estate taxes where we do see the major differences. And as you heard me say earlier, the Hart Act and expatriation, that's the 8 of 15 years with the 3 tests to determine covered expat status. Okay, let's talk about the tax filing statuses available in the US because each one will be applicable to a different couple in a different situation. First, the most common one is married filing joint. I'd say most common and most beneficial in most instances, unless we see a number of fact patterns that we'll review down the bottom here. So only a single 1040 needs to be filed, which is great news. Various benefits, deductions, tax breaks are available, often at higher income levels with the married filing joint. I happen to think it's not that it's part of today's topic, but in Australia where they don't have a tax filing status, as everyone's single, it really does punish the breadwinner type households that where the majority income earner is getting taxed at such a high rate when you may have a spouse that doesn't earn as much or anything compared to this to the working spouse. So in the US, they deal with that with the married filing joint status, and that's what we see here. So the first bullet point you'll see I've got there under the cons is, well, that's really the best, given that today's topic is about spouses, it's really the best filing status to go for in most cases. But many of you on today's call are going to find that your fact pattern doesn't quite fit with that. So a married filing joint status still might not make sense in a number of situations here. If you're unlikely to relocate to the US in the future, that would be one. Because why? You're having to file a 6013 G exemption, which we'll get to in just a moment, to nominate what your tax file. This is for the non-US person. They need to nominate what their tax status is going to, or taxable position in the US is going to be. And that's a once in a lifetime election. And so if you don't see yourself ever moving to the US, it could be a burden. There's no question, actually, it's going to be a burden to have to be part of the US tax system now and forevermore. If you have a non-US spouse who is the breadwinner, this is a pretty common situation that I've seen, and they earn above the foreign earned income exclusion amount, then that could be an issue. If they, not so much in Australia, but if they were to move to a lower tax jurisdiction, so say Hong Kong, the United Arab Emirates, British Virgin Islands, places like this, where now suddenly the non-US spouse that had nothing to do with the US is having to pay taxes at US rates. In Australia, it's not so much of an issue, and the reason for that is because even though it's an attention-grabbing bullet point to say, oh my God, why would I volunteer to have to pay US taxes? It doesn't really work like that in practice. And the reason why is because Australia has higher federal rates than the US. One is given a a foreign tax credit for the Australian tax paid. That's then credited back against the US tax obligation. So we don't really need to worry about that. The downside, if you could call it a downside of the foreign tax credit system, is unless you were to move to a lower tax jurisdiction, then those foreign tax credits really are never going to be used, because you can't use a foreign tax credit to offset US tax, that's US sourced income, and the tax that results from that. So even if you had a rental property in the US, while you're in Australia, you're paying higher Australian tax rates, you're building up these foreign tax credits, you can't use it to offset US sourced taxes, only other foreign taxes. So the only scenario that I could envisage where that would be a benefit to anyone would be if you did move to Hong Kong, UAE, British Virgin Islands, or some other lower tax jurisdiction. That's when that could be of benefit to you, because there would be US tax owing over and above what that foreign jurisdiction is taxing you. Some other circumstances here. What if the non-US spouse owns a considerable amount of the couple's wealth? So that's going to be an issue. What if there's passive foreign investment companies located in the portfolio? That's a whole nother topic unto itself. People get bored to tears talking about that. When you say PFIC, passive foreign investment corporation, people say, I don't care, whatever that is, I don't care. Well, you should, because this is a tax nightmare. It's a very, very protectionist system that the US has, that is nasty, that is pernicious, that will come after your investments and tax you at a much higher rate. And so you want to school yourself on what a PFIC is and how to avoid them. And I've got a whole other webinar and even white paper on our website that talks about that. Is a major shareholder in a foreign corporation, is the US person a major shareholder in a foreign corporation, which would make the spouse subject to the US foreign controlled corporation rules? that could be another nightmare. Again, something that I think is fairly common in the folks that tend to tune into these videos is seeing business ownership and how that CFC rules are very nasty to begin with, particularly impacting Americans abroad who own companies outside of the United States. That's what the CFCs are all about. And so if you have a spouse who has opted into the US tax rules, then all of a sudden they're having to consider this as part of their tax filing as well. Is the non-US, sorry, is the beneficiary of a non-US trust and would be subject to US foreign trust reporting and tax rules. Yet another thing that might bode against married filing joint as a tax filing status. May receive a significant inheritance or a large change in their financial situation in the future. Could be a payout from an accident. That's another thing that I've seen before, or a substantial inheritance. They wouldn't necessarily want to bring themselves into the US tax system. Finally, it doesn't make sense if either spouse is uncomfortable with that joint liability that comes with a married filing joint tax filing status, as both of you will be held liable for each other. What is another tax filing status? This head of household. This is something that requires dependents. You can't simply say, I'm going to nominate myself as head of household and take a better bracket, a better tax filing status and better brackets that come with that. You need dependents in order to qualify for that. This is typically this exists in the US code for a couple situations. Could be divorcees with dependents or widows, widowers with dependents. But it could be a handy tax filing status if the US spouse, if the non-US spouse wants to stay out of the US system, and we're able to show that the US spouse does in fact have dependents, which presumably they would if they were even considering this. So you get better tax rates, standard deductions, and exemptions than married filing separately, and offers potentially less relief than through joint filing status, as I've already indicated, by putting the married filing joint up front. It's funny, married filing separate is one of these statuses where prospective clients have been reading the wrong blogs on the internet. They think they found a loophole in the tax code with the married filing separate status and what it allows. And there's literally only one in a dozen years of being in this profession. Excuse me, there's literally one situation, actually two, now that I think about it, two situations ever that where I would think that all of the cons not that there's a long list here, but the cons are massive. You know, the tax, the brackets are back to single, and you lose a whole bunch of credits and deductions. So it just doesn't make any sense. What are those two exemptions or exceptions where married filing separate might make sense? I've seen this once before with a couple where one spouse was very avant-garde and entrepreneurial with their financial affairs, and that the other spouse didn't want to be liable. Certainly, that makes sense. And the other one is to do with the repayment of student loans and the way that certain income-based repayment strategies in the US can work. Even the higher tax hit on a married filing separate strategy or tax filing status can result in a better outcome given those income-based repayment plans, especially if there's a big difference in income between the two spouses. So I've already alluded to the downsides of this here. You forfeit quite a few tax credits, deductions, and your rates go way up compared with where they would be under married filing joint or head of household. So you heard me allude to this earlier, the once in a lifetime opt-in with the 6013G election. Okay, so it's an opt-in for the non-resident spouse to the US tax system, and they can do this once, and I mean once. Even if they divorce and later remarry, doesn't matter, that this status is going to follow them. Effectively, the non-resident spouse is electing to become a resident alien under the Internal Revenue Code. So it's as if that non-US spouse is living in the US and has become a US tax resident. And the way that they do that is by signing and attaching a statement to their first joint tax return. And also, it's also qualified to make the election in the first place. And there you go. So very, very important that we consider this. Consequences of making the election: having to disclose your spouse's income on your return, which could lead to steep tax assessments, especially if their income is already being taxed by their home country. So that's going to be really important, and why we engage in financial planning. I just spoke with a dear client of mine last week, where the one spouse is on maternity leave presently, and the question is, what's her income likely to be going forward in the future? It would be a situation like that where, and they've recently returned from the US. Their fact pattern's a little bit different here, where neither of them are US citizens. But if that were the case, that would be precisely the scenario here, where we would have to think about what's the likelihood of returning to the US, what is the non-US spouse's income likely to be in the future, and might it still make sense for them to file this form in order to get the US tax rates, or does the foreign tax credit on the primary income earning spouse's income already take care of the situation and avoid any further complications? Consequences of not making the election: they'll lose deductions and credits so long as the spouse does not have a US-based income and is not claimed as a dependent by another US-based taxpayer. You can request and be, this is an important exemption right here, you can request and be granted an exemption from reporting the earnings on worldwide assets of the non-resident alien spouse when you file your return. That could make a ton of sense when we have the opposite situation, when we have an American abroad who is the primary income earner, and the spouse doesn't want to get into the US system, then they can elect their way out of that. Okay. Ownership of assets. In certain circumstances, including mixed nationalities, there are multiple reasons to keep things separate. So this is a big one. Attribution of income from jointly held assets could be different in the country of residence. What does that mean? This is to do with joint account ownership. So we'll be going through this in a moment, but to refresh your memory, you can hold your account only in a number of ways. You can hold a joint account, joint with right of survivorship, JTWROS is what it's known as. You can hold it individually, just directly in your name. You can hold it as a tenant in common, and some other obscure, trust account type ownerships, etc. So if you were to hold an account as a non-US person with a US person, then there's going to be issues when tax time comes along, as in determining who should recognize that income, who and how that income should be recognized and attributed to each of those spouses. One person may be in the US tax system, the other may not be. Should a joint account hold, what investments should the joint account hold? We need to be mindful of PFICs yet again, which essentially means any non-US ETF, mutual fund, et cetera, et cetera. It's a hedge fund, private equity, pooled investment, the list goes on, REITs, anything that is not a US pooled investment is likely to be a PFIC with significant tax implications. So that would suggest to me that the non-US spouse be the one that holds those kinds of assets. So there's the tax reporting on the attribution, as we saw just a minute ago. US spouse will have to include joint foreign accounts if the amount exceeds $10,000, or for FBAR filings, and then other amounts for FATCA, for Form 8938. So a whole bunch of additional tax reporting could come into it as well with joint account ownership. Where the US spouse owns substantial foreign financial assets, yes, FATCA might have to, Form 8938, there it is. Okay, so the foreign earned income exclusion. This is interesting. It seems like it's going a little ways off what we're talking about today, but it's really not. If you have a spouse who has uh, who is an American citizen who is therefore a U.S. tax resident, also, we need to be mindful of what their U.S. tax situation is likely to be. As you've heard me say earlier, in Australia, this actually isn't of great significance. And the reason for that is that the federal rates are higher than the US federal rates are. And so the foreign tax credit will largely deal with that, but that's not true in every jurisdiction around the world. So understanding where the non-US spouse may need to consider whether they would take a foreign earned income exclusion or not. So not so prevalent in Australia, but nevertheless could be a factor elsewhere. Okay, we're just talking about more definitions to do with foreign earned income exclusion. Let's talk about account types, account ownership types for non-resident aliens. So joint with right of survivorship, JTWS, this is very, very common one that we see with spouses. And indeed, it's really designed for spouses. It has some major benefits on the estate planning side. It avoids probate. If one spouse dies, the other immediately inherits that account. You don't have to worry about that. By law, each owner has 50% share of the account. So it's almost like a community property type account where you own half of it already. You can probably see where I'm going with this and why as a joint account would be so problematic for non-US spouses, because how is that the income, the capital gains, the dividends from that account going to be taxed in the US if we can't determine the income attribution readily? So Form 1099s are generated for the US spouse because they've provided a social security number, but not so for the non-US spouse because they're outside of the US financial system. So that could be an issue. This isn't a problem necessarily when you see non-US folks in the US. It's the repatriation where that becomes or could become a headache. Tenants in common, this is another approach. This would be one where you pre-specify who owns what percentage of the account. It's not as neat when it comes to estate planning because it doesn't have those rights of survivorship. There is actually a joint tenant type account that exists, but it's quite rare to see that. So each person's proportional share of the account passes via a will. So that means probate would need to occur, and that can be time consuming and costly. And then do keep in mind that for the non-US person, the default withholding rate is 30%. However, with the US-Australia tax treaty, that does get a lot better. So it's quite lower than that. But I will throw in a caveat and say, while the tax treaty says that, and it is the law, that doesn't mean that your custodian, your US custodian, is going to understand or accept that. And we see this time and time again where the custodians have exactly nothing to gain by being liberal in following the law and saying, oh, the exemption for Australia is 0%. Fair enough, we won't withhold zero. They say, no, we're just not doing that because we have nothing to gain. You can file your tax return at the end of the year and get your money back from the IRS, and we'll put the risk on you. So that's kind of another benefit, I guess, of working with an advisor is not having that disruption to your cash flow and not having that unpleasant uncertainty that comes with having to file US taxes. Alternatively, you can do individual accounts. One spouse has full control over their accounts. Simpler, certainly, but the same estate planning issues to come up with this one. Perils of joint accounts for the non-US person. So as I've indicated a number of times throughout this presentation, there's issues with PFIC. So if you own a PFIC, I'm thinking specifically in Australia. If you're in Australia, you have a joint account with your your American spouse, or you are an American, you have an account with your non-American spouse, and you hold managed funds, unit trusts, you hold REITs, whatever, okay, that's going to be a big problem for the US tax reporting side. How do we attribute who's earned what in that account? As I've already said, FPAF, FATCA reporting issues come up. And then with the US accounts, again, we've got income attribution problems. We may bring the non-resident alien client into the US system, and then it becomes a complex tax argument to say that, in fact, the attribution that we have chosen does in fact make sense and is fair and equitable. Okay, that is a mouthful. I'm going to open it up for questions. I see, looks like we have a couple here already. Before I do, just thought I would mention, where can you learn more? If what I've spoken about today and these strategies sound like something that is applicable to your situation, and you seek a lifelong partner to help you manage your international and cross-border financial affairs, then please reach out. Click on our Get Started button at arete-wa.com. And we would love to assist you further there. So let me take a look and see what questions we have already. Okay, so is this recording? Yes, it's going to be sent out, as I mentioned at the outset. So any chance you're going to cover what happens if you renounce US citizenship and retire in Australia? Not on today's presentation. That is the topic of a future presentation, Will. The renunciation that does come up. Perhaps we may be privileged, quite possibly, if it's the same individual that I think it may be. We may be privileged. Let me just see at the attendee list. If John Richardson here is in fact the same John Richardson that I'm thinking of, then we have one of the world's experts on renunciation on the presentation here. So it's a different topic altogether. But other questions? Okay, thank you. You're welcome, William. Just bring up the Q&A panel. Need to close out of here. What if you have an average income, let's say under 100,000, but you buy a property worth over $1 million or $2 million? Can you tell me what country you're thinking of? I need to know more specifics of that, Livia, to have any attempt at answering that question. D, hi D, I've always filed as head of household. Do I need to change that when my kids turn 17? You need to change that when your kids, at a certain age, that does come at the limit of my tax knowledge. There is a point, it is around 17 or 18, where you can no longer claim them as dependents. And so, yeah, you would have to move back to a single filing status in that case, unless, of course, you spoke with your spouse and decided to do the 6013G election and see if they're interested in being brought into the US system, if an assessment of the pros and cons proves worthwhile in that situation. So Livia, thank you. You're buying in Australia. I've always filed as head of, sorry, wrong. What if you have an average income, but you buy property worth over $1 million or $2 million buying in Australia? I guess I don't know what the question actually still is now that I know that you're in Australia. The question is what? Does it make sense to bring your spouse into the US system, or that's just not clear. Megan, if I file as head of household, can I claim my stepkids here in Australia? We have full custody. That's a great question. And you should talk to your tax preparer on that. I'm inclined to say yes, but I'm not a CPA, and I really couldn't say that definitively. But I would think so. I would think your stepkids could be claimed as dependents. Wonderful. So back to the Q&A panel. SCD's got a question there. Please keep the questions coming. I'll stay on for as long as they keep coming. James writes, I am British, an Australian permanent resident with an American wife. Okay, gotcha. We have started a business here in Australia with joint shareholdings. Okay, so she has a controlled foreign corporation. What are the reporting requirements for US and non-US citizens? So just yesterday, we recorded lesson 4 for the GFP masterclass, and it goes into detail on that. And there are so many forms; it's incredible. But that's really it's an extraordinarily complicated situation. If she has voting power, if she has ownership above, I believe it's 15% of that company, I'm going to guess she's 50%. Things get incredibly complicated with that. So, and it's beyond the scope of today's presentation, but really extraordinarily complicated. Okay, Livia, sorry, if you are a US, non-US citizen couple and you buy a property with a high price, will you be taxed on all of that considering it's an asset? Well, you won't be taxed on buying an asset, but there are tax implications for possibly tax implications for the non-US citizen spouse, depending on what elections you make and what tax filing you make. So merely buying the property, I don't see as problematic. There's no FATCA or FBAR reporting requirements that come up merely with buying the property. But it's the income side where things get complicated. And indeed, if you sell that property and there's a capital gain, then there's another issue right there. So that you'd have to think about. Okay, we'll give folks just a moment more to come along and ask some questions. So Laura, hi Ashley. I am an Australian citizen and Chris is a US citizen. We're married and thinking of relocating back to Australia in 2 or 3 years. I'm not planning on getting a green card because of complications with tax. Fair enough. Yep. Okay. Considering the time frame, how should we think about moving our money over to Australia? The advice we've received so far is to do it gradually. Da, 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 da. Yep. However, knowing that we would get taxed on worldwide assets in the US, would we be better to wait until we're in Australia to move over that money in bulk? I think so. It's a very, very personal question. The way I would think about that would be it really depends on the immediacy of your goals and funding those goals back in Australia. So if you see yourself as needing to buy a house as soon as you get back, then obviously you're going to need a significant amount of money in Australian dollars at that time. Otherwise, is there a huge hurry to convert those funds? I think you're in a good position where you still have time, and do stay tuned for next month's webinar where we'll go into part 2 on this to do with estate planning and investment implications. But you still have time to potentially retitle assets into your US spouse's name, and thus when you move back to Australia, avoid the worst of what could come with being brought into the US tax system by virtue of being a joint account holder. I see you're thinking part of the benefit of converting that beforehand is that you wouldn't be brought back into the US system, but there are ways of doing that, of shifting the assets to your spouse before that happens that would buy you some extra runway after that time. And the other thing is, as I mentioned earlier, with foreign exchange, it's anything but a linear journey. It's not as if the Aussie dollar is simply going to strengthen against the US in perpetuity. It may or may not. No one knows. So there's no hurry to get it back necessarily. The only thing we can say with certainty is that in terms of a cost environment, you have a better, lower cost structure to invest in the US. And there are other moves to make, as you heard me say a minute ago, with getting those assets out of your name to simplify your tax filing once you get back to Australia. All right. Okay. Thank you. You're welcome, Megan. Thank you. It's been very informative. Thank you so much. Look forward to future episodes. All right, Cameron. Regarding retirement accounts like a 401k, Roth IRA, would it be more beneficial to keep those accounts in the US and leave them to compound, or to pull that money out? Is it possible to contribute to these accounts when living in Australia? My goodness, Cameron, it's so funny how simple questions can become complicated, right? Depends on whether you are a US citizen or if you're a permanent, if you're deemed a covered expatriate. Depends on your US legal status is what would what would be the determining factor there. If you're not a U.S. Tax resident, a non-resident alien, the flattering term for that, if you're not a U.S. tax resident, then I would say that you look to the tax treaty. That is likely a more efficient way to get your money out, so you don't have to worry about that in the first place. Roths, I don't like them anyway. If you've attended any other webinars, you'll know that that can result in double taxation. So they make sense when you're in the US, but if you're domicile, if you're planning on being abroad, they really don't make sense. They end up in double tax, so they're no good. But if you are a US person, then remember, as you will always be a US tax resident, therefore you won't have the ability to utilize the tax treaty to get that money out before retirement. It will stay there. It will stay in the US until a condition of release is available to you. And what's that likely to be? Age 59 and a half. And then they will be deemed US sourced assets as well. So when that money comes out, it's going to be taxed back in the US. So not such a great outcome. Let me just read your question again, see if there's anything more there regarding retirement accounts, blah, blah, blah. Would it be beneficial to keep those accounts in the US? Well, I think the first part of my response to your answer was you may or may not have a choice on that because that decision may be made for you by virtue of your US personhood and your status in the US. Is it possible to contribute to these accounts when living in Australia? Yes, it is. And there are circumstances where it can make sense, but they're quite narrow. Typically only when you're in Australia and your US income is deemed to be US sourced. Typically, the sourcing rules for income, for jobs, for your work is sourced to the country of residence. So you would be if you're working in Australia, in most cases, but not all, you would be deemed it would be deemed to be Australian sourced income, but not all situations are like that. So you may have a situation where somehow your income is deemed to be US sourced, even your labor, your everyday job is deemed to be US sourced. If that was the case, then yes, I think making a contribution to a 401k would still make a lot of sense, but then you need to, the next thing you need to worry about is how's the ATO going to view that if you are an Australian tax resident or become one at some point in the future, because remember, they don't recognize each other's retirement accounts. So what you have in your retirement account in the US or in Australia will not receive the same beneficial tax treatment by either country. Laura, if you're a US citizen and have a Roth account, does that change your position on that answer? I would be going back to your question before about the moving of, are you referring to your previous question, Laura, about when to move money? Not sure if you could type in and clarify that. Sorry, the question I just answered about Roths. The only situation where a Roth, I mean, gosh, we go down a rabbit hole with Roths because people have buyer's remorse with having contributed, because 99.9% recurring of all financial advice is in the US is focused on domestic residents. It's like there's basically nothing for international and cross-border. And in international and cross-border, basically every practitioner is agreed that Roths should be treated with great caution because they do not provide the promised benefits when you move abroad. Are there situations where it might make sense? Yes, I could see a situation where you have you make a contribution in a low income year into a Roth, maybe do a Roth conversion from a 401k into a Roth, pay a very low tax rate on that money. You'd need to be in a very low tax bracket to begin with. And then as soon as you get back to Australia, if you're a non-US person, you could distribute that account immediately. But how would that be better? I don't think that would be better than just distributing, even if it was a 401k. You'd get an even better tax result by not doing the Roth conversion in the first place. So I think it's actually too complicated to go into over the phone. It's like I'd need to literally noodle on, I'd need to noodle on that particular situation and the question posed which is what I would do for a client. All right, so haven't seen any more questions come in. Thank you, everyone. As I mentioned, there will be a second part to today's presentation, given that, that we need to explore the investment implications of this and the estate planning implications as well. All right, thank you so much and have a wonderful day.